Tonight, the world's markets are watching oil, not speeches, not press conferences, oil. A conflict in the Persian Gulf has placed the Strait of Hormuz under a microscope. Through the narrow passage flows roughly one-fifth of the world's oil supply. When ships hesitate there, the world economy begins to feel it. Economists often describe the chain reaction with a single equation. At the end, I'll go ahead and show an image of it, but to read plainly, the equation says S. The S&P 500 is equal to the earnings of the companies inside the S&P 500 minus the earnings lost from currency effects caused by higher oil prices, all divided by the base interest rate plus the inflation pressure created by oil and the response of central banks to that inflation. In other words, oil affects both sides of the equation. The top of the fraction represents corporate earnings. When oil rises, transportation costs rise, manufacturing costs rise, and consumers spend more money on fuel. That reduces the profits companies earn. There is another force at work in the numerator. When oil prices rise, Europe and many parts of Asia must send more money abroad to buy energy. Their currency weakens against the US dollar. A stronger dollar means American companies earn less when foreign profits are converted back into dollars. The denominator of the equation describes interest rates. When the symbol RO represents the normal interest rate in the economy when inflation is stable. The letters A and B represent inflation pressure. Oil is a major ingredient in the price of almost everything that moves across the road, a rail line or a cargo ship. As oil prices rise, inflation rises. Letter C in this equation represents how central banks react. When inflation increases, the Federal Reserve raises interest rates to slow the economy. So the denominator grows. When the bottom of the equation grows larger while earnings weaken, stock prices fall. This is why traders watch oil prices so closely. Three levels matter. At roughly $80 to $85 per barrel, the global economy can absorb the shock. Inflation rises slightly. Markets wobble but remain stable. But at $100 per barrel, the equation begins to shift. Inflation pressure grows strong enough that central banks delay interest rate cuts or raise rates again. The denominator in the equation expands, pushing stock prices lower. Now, above $120 per barrel, the numbers became dangerous. Transportation costs surge, manufacturing slows, consumers pull back spending. Inflation rises while economic growth weakens. That combination has a name: stagflation. For now, oil remains below those crisis thresholds. Prices in the 70s suggest disruption, but not collapse. Yet every tanker moving through the Strait of Hormuz tonight carries more than oil. It carries the variables inside the equation. The earnings of companies, the strengths of currencies, and the interest rate that determine the value of the world's stock markets. And investors quietly continue to do the math.
The browsers poke and secretly stern as I speed through the finish. The flags go down, the fans get up and they get out of town. The arena is empty.